Alright, hi there. In this video I'm going to talk about a very valuable tool that will allow you to see how expensive or cheap, based on valuation multiples, various ETFs from all around the world actually are. Alright, so let me quickly walk you through what we are actually going to cover in this video, so you will know whether you actually have to stick around or not. So first of all, I'm going to talk about a very simple wealth building formula that you need to be aware of. Then secondly, I will talk about one problem that comes with this wealth building approach. Thirdly, I will talk about the tool that I already mentioned in the introduction of the video. So basically it's a tool that will help you to visualize how expensive various ETFs from all around the world, from different geographies, and maybe ETFs with a focus on specific sectors or industries, well, how expensive or cheap they actually are and were in the past. And then finally, I will talk about one advantage of active investing that passive investing cannot achieve or offer to its followers. So without further ado, let's take a look at the first chapter of the video. So let's briefly talk about the beauty of passive investing. Well, I have once created this chart here, and just keep buying is basically one approach, one formula that is going to make you rich over the long term if you actually stick to this approach. So even Warren Buffett, if you look at the quote that I've included here, he acknowledges that he's a very poor market timer and that most market participants will never be able to sustainably and successfully time the market. So what do you do instead? Well, you have to take a look at the long-term trajectory of earnings, and passive investors will focus on the long-term earnings trajectory of various companies in a specific country, or maybe if they invest in a global ETF, the earnings trajectory of companies from all around the world. So the idea is that you just keep buying, which means you dollar cost average. Ideally, you just automate the process. You automatically transfer some of your income directly into your brokerage account. You then directly invest it into 1, 2, or 3 low cost and broad ETFs. And then you just stick to that formula for the rest of your life. That's the idea here. And I think the beauty of it is that it's not very time consuming. You don't have to read annual reports, follow what the management of various companies is actually doing on a daily or quarterly basis. You don't have to read write-ups by analysts and so on and so forth. And this is something that Lucille Tomlinson also shares. Actually, what you see on screen right now is a quote that Benjamin Graham, so the father of value investing, he already referenced back when he was writing his book, The Intelligent Investor. Well, to get back to the quote, I'll just read it to you. It says, "No one has yet discovered any other formula for investing which can be used with so much confidence of ultimate success, regardless of what may happen to security prices, as dollar cost averaging," which again is just basically a synonym for just keep buying. And yeah, if you do decide to get exposure to the right market, you can do very well. What you can see on screen right now are basically up-to-date figures of the performance of the S&P 500, basically over the last 100 years. The numbers are from the NYU and Swart Demodaren. And what you can see is that over the last 95 years or so, the S&P 500, so the biggest 500 companies in the US, have delivered real returns, that's adjusted for inflation, of 8.27% compounded annually. And you can do the math, just plug in the numbers into a compound interest calculator, and you will see that if you invest for the long term, you just dollar cost average, well, you can't help but actually become significantly wealthier than you are today. And just to wrap up this first chapter of the video, what you can see on screen right now is a chart that I have shared previously. The average retail investor tends to do very poorly in markets. That's mainly because they can't control their emotions. They will make poor purchasing decisions. They might buy when everyone is greedy and the securities prices are actually trading at a very elevated level, which will lead to poor forward-looking returns, or they may actually sell securities when everyone else around them is panicking. And yeah, the beauty of passive investing and a dollar cost averaging approach is that it's a very systematic, unemotional, rational approach. And if you stick to it, you basically eliminate this behavioral risk. However, there's one problem with this beautiful approach. What you can see on screen right now is basically a chart that is comparing the valuation multiple the S&P 500 was trading at to its forward returns over the next 10 years. And what you can see is that there's a strong correlation between the current valuation multiple and the expected forward returns. So the higher the current valuation multiple, on average, the lower the future expected returns, again, over the next 10 years. This idea is also backed up by this chart here. What you can see here is the CAPE ratio, so that's basically the Shiller PE in yellow, and then in blue you see that the lower the Shiller PE is, the higher the expected forward 20-year returns of the S&P 500. Yes, and if you make the mistake of buying into an index, it may for example be the S&P 500 at a very elevated price, well then there are also periods during which the index may perform relatively poorly. So I've just highlighted 3 multi-year flat return periods for the S&P 500. Back in the 30s and 40s, there was actually a 25-year period during which the S&P 500 didn't deliver any nominal returns for investors. And then there were actually 2 more periods during which the S&P 500 was flat for more than a decade. So especially nowadays, everyone is hyped about ETF and passive investing, and it kind of feels like everyone believes that you cannot lose money in ETFs. But as we just highlighted, there is actually also the risk, regardless of which index you invest in, that you have to endure multi-year flat return periods. So the idea that passive investing is always the best strategy is simply not true. The reality is that valuation actually matters also for indices, and they can give you a pretty good idea of what the forward long-term returns are going to be. And the main reason for the poor performance of the S&P in these multi-year flat return periods was that the starting price of the index was relatively high. So how can you figure out how expensive an index actually is? Well, it's fairly easy for the S&P 500. Basically, you just have to Google, and I'm sure you will find websites that will show you the current PE ratio or even the Shiller PE ratio. But when it comes to other indices, maybe less known ETFs and indices, well, it's harder to find actual data on the current PE ratio, the price to sales ratio, maybe the price to operating income ratio, and so on and so forth. And quite recently, the website Käufen has actually introduced exactly this feature. So what I will show you next is actually how you do that, what kind of valuation ratios the tool offered by Käufen actually offers. You can even compare the current valuation multiple to the historical mean over various time periods. And obviously you can also then compare the current valuation ratio of whatever index you're looking at to the ratio of other indices, but also companies. So let's quickly do that. All right, so I just logged into Käufen, and what you can see on screen right now is basically a bunch of ETFs that I have on. It's not really my watch list, but it's a list of ETFs that I sometimes compare some of my holdings to in terms of valuation and some other key metrics. So let's just take a look at the VU index, which is basically just the Vanguard ETF that is tracking the performance of the S&P 500. And here's how you do it. So basically you're just going to add a data point. Let's just go for the price to earnings multiple. So I'll just type in PE, then we choose the price to earnings multiple, for example, or what you can choose here is between the last 12-month multiple or a forward multiple. But let's just stick to the LTM multiple. You click on it and voila, there you already have your final result. What I then like to do is, first of all, I would like to make the line a little thicker. So here's how we can accomplish this. By the way, here you can also then switch back and forth between the last 12-month multiple and the next 12-month multiple. But as we just said, let's for now stick to the last 12-month metric. And yeah, what you can see is that as of today, basically the S&P 500 is trading at a last 12-month earnings multiple of around 24.3. And compared to the last 12 months again, you can see that that multiple is relatively high. We were basically at a significantly lower multiple in late December at a multiple of 20.5. And obviously you can change the time period you're looking at. If you look at the last 3 years, for example, you will see that the multiple has come down compared to the 2021 multiples, which peaked at a multiple of 40. Here's the PE multiple of the S&P over the last 5 years, and here over the last 10 years. Now, obviously, you can also look at other valuation multiples. The price to sales multiple, for example, also works for ETFs or indices. Just get rid of the PE multiple here. And another data point you might want to look at is the price to, it's the enterprise value to operating income multiple. So another thing you can do is you can compare the valuation multiples of some of your holdings to the valuation multiple of the broader index. So for example, if we just stick to the EV to EBIT multiple here, and maybe instead of the last 12 months, we're going to choose the multiple that is considering the next 12 months of operating income, and then compare the multiple of the S&P, which stands at 18, to the multiple of some well-known holdings. Like for example, let's take a look at Matter platforms. As you can see, Matter is actually cheaper on a relative basis if we compare the forward EV to EBIT multiple of Matter platforms to the S&P 500. Personally, as you know, I'm a Matter shareholder. I would argue that Matter is a far superior business compared to the average S&P 500 company. So I find it quite interesting that Matter is actually trading at a lower multiple. We could also compare the multiples of these two investments to, for example, Microsoft. And what you can see here is that compared to the S&P and Meta platforms, Microsoft is trading at a much higher multiple. The EV to EBIT multiple of Microsoft is, as of today, 26.4. And one could certainly make the case that Microsoft deserves to trade at a higher multiple than the S&P 500 index, because just like Matter, in my opinion, Microsoft is a business of much higher quality than the average S&P 500 business. All right, then the last thing I wanted to show you is that you can also compare the multiple of the index to the median over a given time period. Like for example, for the S&P 500, the PE as of today is, as we said, around 24. Let's compare it to the median over the last 10 years. So all you will have to do is you click right here and then you add a statistical band. And as we just said, we're going to choose the median. And what you can see here is that the S&P 500 as of today is trading above its 10-year median. If you now change the time period, the median will automatically also adjust. This is the median over the last 5 years. And over the last 3 years, the median has been 23.5. All right, finally, let's talk about the beauty of active investing. So what I have explained previously, that if you invest passively, you basically give up control on the valuation variable. And that's because even if you can acknowledge that an index is trading at an elevated level, what are your options really? Well, you have basically two options. You can buy regardless of the current valuation. You just continue dollar cost averaging. But to be fair, if you buy the S&P at a PE ratio of 30 or maybe even 35, 40, you will have to accept that your long-term returns are likely, obviously we don't have a crystal ball, but are likely going to be below the historical average of the S&P 500's performance of around 9.8% nominally compounded annually. Or you have to wait until the price or the valuation of whatever index you're looking at actually comes down. But as we have shown, this waiting period can take a long time. It might actually take multiple years for the index to actually trade at a more attractive valuation multiple again. And waiting in the world of investing can also be incredibly costly, because then you will be sitting on your cash, and your cash is almost guaranteed to lose purchasing power every single year. And as a passive investor, you not only give up control about price, but also about ethics and quality. This is actually something that I have addressed in previous videos of mine. More recently, in my very last video, I talked about the quality factor, so make sure to watch this video as well. And basically just wanted to bring this up, that you are not only giving up control on the valuation variable, but also on other components of an investment framework. And this is why I love active investing so much, because basically regardless of where the S&P 500 stands at, where maybe an ETF focused on the Asian markets stands at, you will always be able to find individual stocks that are attractively priced and are thus likely going to deliver promising, satisfying, maybe even market-beating returns. So this is something that I talk about on this channel all the time, the combination of focusing on quality businesses that are also trading at attractive prices and fairly low valuation multiples, at least relative to the expected growth going forward. And if you want to learn how to do that, how to find these companies, and maybe also how to identify quality businesses, feel free to reach out to me. I offer a mentoring program that stretches over a period of 21 weeks. So it's quite an intense program, but I can promise you that you will be a very good investor after that if you actually put in the work. With that being said, let's wrap it up here. I see you in one of my next videos. Take care.